Welcome back to the Don and Gino Real Estate and Finance Show right here in your hometown station, AM 1220 KHTS.
And remember, our goal is always to guide you to personal and financial wellness.
Well, welcome back to the second half of the Don and Gino Real Estate and Finance Show every Saturday, 9 a.m. to 10 a.m., sharing what you need to know, want to know, should know about real estate, finance, and everything else about your community. And today, especially about what's happening in this crazy financial world. And we have our guru has been actually on our show almost from the very beginning, Mr. Chris Ingram with Ingram Financial Solutions, also our workout buddy that makes us look bad at the gym because he lifts small trucks while we're lifting little girly weights.
But you run circles around me, so...
Yeah, you don't like to run much. No. I got that. Well, I have to. You're bigger than me. I have to be quicker than you.
Right.
That's how that's the cavemen that survived. It wasn't the big guys that fought the dinosaurs. Mm-hmm. It's the quick little suckers that made it back to the cave.
Right.
They're the ones that survived.
Right.
All right, speaking of surviving.
It also takes less food to feed you.
That's true.
I've seen you eat. You eat like a bird.
There you go. That's how we survive.
You and I need to eat like lions.
Dinosaurs.
Yeah, dinosaurs. Exactly. Again, Chris Ingram, Ingram Financial Solutions. Before I forget, because those of them who have been listening to the show for the first half of the show, I guarantee you, I like this guy. He's calm, cool, collected, knows his stuff, very educated. Evidently, Don and Gino, who utilize Chris, are very pleased, not panicking. Our portfolio has been doing great. And I'm not putting, it's not a commercial, so I'm going to have to put the little disclaimer. It doesn't mean that your portfolio is going to do as well. But bottom line is, if you want to talk, you need to talk to a professional. Somebody that actually knows the idiosyncrasies of why the markets do what they do. Mm-hmm. I know because we've done their show now. This is the best thing that's ever happened for us, Chris, is doing this show and doing the National Real Estate Cafe every day, which you can get at nrecafe.com or find out more at donandgino.com. But we do a video every day. So when you watch trends and what's going on in the market and really pay attention, it's really not rocket science. You really kind of have a sense of where the market's going and why it's moving the way it is. If you're not educated, anything will panic you. You listen to the media and you believe the media. Now we actually debunk the media most of the time because most of the time they don't even know what they're talking about.
Right.
So that's why we say use a professional that actually understands what's happening in the market today. And that's why we brought you on talking about the crash versus the correction. And Gino, I cut you off. You had a question for Chris, but we had to go to break.
Well, we talked about the tax reform creating a little bit of fear in the market of have we poured fuel on an already hot market that's going to create some inflation, and now we've got to control inflation by rising rates, and now if we raise rates too quickly, corporate profits are going to get cut by the cost to borrow being too high. Mm-hmm. However, the question is, those that are passing tax reform, did they see this coming? And they said, hey, we're going to have to find a way to keep corporate profits healthy. Let's do a corporate tax cut. This is going to be a healthy thing because as interest rates rise, it won't cripple our economy.
Yep, it makes sense. I mean, we were already looking before the year ever started, before tax reform ever came in, that we were expecting something between a 2 or 3 rate hikes throughout the course of the year. So, yeah, they may have thought this is the best way to allow that to happen and not have it be a negative.
But here's the beautiful part about media, and that's why I love that we can talk to you and we don't panic about our portfolios. Okay, this is part of it. We don't know how any of this stuff really is going to play out down the road. Just like when Trump came in, there was that Trump euphoria, and the stock markets rallied, and the interest rates went up, and it was crazy. And then everything settled down. We're like, oh, this is going to take some time to figure this out and see what Trump can do in his administration, who's going to do what. It's kind of the same thing now because everybody's panicking a little bit, going, oh, there's tax cuts, everybody's getting raises. That's not going to happen. There are some abilities for companies to potentially raise raises, but right now everybody's panicking like everybody's getting raises, so we're going to have wage inflation, and it's going to raise interest rates, exponential. It's not going to happen that way.
No, and like you said, I was kind of excited for tax reform. I thought it was going to be a good thing, and I think it still is a good thing, but when we went and saw our CPA, he's like, yeah.
Not you guys.
Not you guys. And we're like, oh, what do you mean not? What do you mean not us? So how many people across the nation are feeling like, not us?
Yeah.
Okay.
Well, I think you touched on a good point. Is from now until we see those tax returns, it's all just speculation on how much of a benefit is corporate America actually going to get and what is it actually going to look like. And again, kind of goes back to what you were saying before. Nobody knows. Nobody has any clue. So you're continuing to work with the information that you have, make educated guesses and decisions on how you should manage it or what it means for your portfolio or your financial future. and do your best to stay on top of it and not just turn a blind eye to it and just forget about it, but understand what is the potential and what you should be doing to either take advantage of it or make sure that it doesn't hurt your portfolio.
Well, that's what's nice, Chris, is I know, like, we're more educated now to kind of work better with you. We're probably a lot better clients because we're, maybe Gino's
not me.
Gino gets too involved. He thinks he's smarter than he is sometimes because he tries to do your job. But at least we're educated enough to understand when you say, here's something to look at, guys. Here's a position I think we need to be in. Hey, just so you know, the market did tank, but here's actually an opportunity. You look at things differently because I know when we look at the markets now with what's going on to interest rates and why they're moving and why they should move, and you know, we're pretty good. I can pretty much nail, hey, I think the market's going to tank until here, and it should stop based on historical, you know, trends. I think it should stop here and rebound off of that. If it doesn't, but we kind of know what to look for. We know where the stops are, the resistance levels, support levels, and all that type of stuff to help our clients.
Actually, can I throw something in there? How much of this was auto trading, right? So a lot of this, right, we didn't have to deal with this 15 years ago, even 15, 20 years ago. This wasn't a thing, but a lot of these are just automatic stops where nobody even made, not one human was involved in the decision. It just they were already markers where people said, if I make this dollars, I'm out.
Right.
And so some of that happened, I'm sure, as well.
Yeah, and you have to look at what happened over those 2 days with that size of a drop and realize that we're playing in a different market environment. You go back a couple of decades and you didn't have these algorithms and computers and whatnot that were deciding, making investment decisions for these traders. And so when you have a market that starts to drop that quickly, you have all these automatic executions that are taking place. Then you get margin calls that start to come into play where people are having to cover their margins. And so you get this very quick drop and move in the market that you probably wouldn't have got prior to having all of those types of trading systems.
So it's unnatural, so to speak, for if we look at the long term of the market. So really what we need to look at is the last decade when that's been, what was the first time we had you on when that happened? We called it the fat finger, right? Somebody hit the wrong button and it just kind of set everybody off.
How long ago
that was? Probably 5-6 years ago. It was a
Mm-hmm.
fat finger situation. That was the day we lost 900 points. So, now we know better than that, and we know what this really is all these set trades that are going to happen. So the new normal is to see these rapid sell-offs, because as risk increases, those algorithms read that the risk increases and they just get people out.
Right. And so let's go back to what we were talking about before, crashes versus corrections. So corrections can happen rather quickly, especially in this day and age with all of these factors that we're talking about. Corrections also, the underlying fundamentals are still sound. Okay, you don't have to be in a terrible place with the economy or whatnot for a correction to occur. Corrections are healthy and they're natural. You look at what's going on right now, we're in the middle of earnings season. You've had more than 50% of the S&P 500 companies have reported earnings. Over 80% of them beat expectations. So you're talking about a very, the cause for concern was the economy looks too good, jobs look too good, wages are going up faster than expected, earnings are good on their own without the tax cuts already taken into account, tax reform, everything, the underlying fundamentals look very, very healthy and good. So when you get a pullback like this, you have to understand that correction is something that is probably going to be short-lived, and it's also going to rebound rather quickly.
So I'm starting to feel old when I talk about things like this, but we'll probably look on this time 20 years from now and say, what a Cinderella story of an economy that was in shambles after the crash in 2007 and came back and roared with a vengeance over the next 10 years and maybe over the next 20 years. And, not the Make America Great Again thing, but really, if you look at it, what a great story about crash and burn and recovery.
Well, at least we learned our lesson from, the Depression, because unfortunately the government didn't get involved, and a lot of people basically starved to death almost.
Yeah, so it's an interesting experiment, right, where the government for the first time stepped in through the kitchen sink at stimulus, really did. I mean, now the only question is, what are we going to do with all that debt?
Right.
And in fact, I know what we're going to do with all that debt, and the government's probably cheering inflation because we're going to inflate our way out of that debt. That's the only way to get out of that debt.
Right. Yeah. I mean, it's amazing, but it also should remind people that even when a crash happens, like what happened in 2008, you recover even from those. Now, a crash they're typically longer, they're drawn out. You have a recession. I mean, at that time we were talking about, are we going to have a depression? I mean, things are bad. Corporate earnings look terrible. People are closing their doors, bankruptcies.
GM bankrupt. I mean,
Yeah, Bear Stearns, Lehman Brothers, Washington Mutual.
Big daddies.
Banks are all over the place. You know, when that type of stuff happens, these falls in the market are long and drawn out. They can be 50% from top to bottom. That's a crash. That's very different than a correction. But let's go back to that and say that even if you invested in October of 2007 at the very peak before that crash happened and you went 50% from top to bottom, you still have more money today if you just would have stuck with your plan and wrote it out.
Hence, if stocks were not liquid and they were traded more like real estate, you can make the same amount of money, and it's a great investment class as well.
Can't leverage it the same as real estate, though.
No, you
All
can't.
right. We got one more segment left, and we're going to go into a couple things. One, we're going to talk about, we're talking about what's moving the markets. One of the things that could move the market, we have a new Fed chair coming into play. What's going to happen with interest rates? What's going to happen with the market? What's he going to do? And then we're going to get some tips from Chris on how to handle this market, how to be prepared for it, how to not panic over it, what are some of the advantages, how can you take advantage of it? We'll find out more from Chris Ingram of the Ingram Financial Solutions on the Don and Gino Real Estate and Finance Show. We'll be right back for the final segment.